Warren Buffett put over $10 billion into IBM and walked away 6 years later with almost nothing to show for it. The man who turned a candy store into a fortune. The man who avoided tech for 50 years. He finally bought a tech stock because it looked like a bargain, and it was a trap. Here's what makes this story matter to you. IBM looked cheap. Low price to earnings, fat dividend, buybacks everywhere. Every metric a value investor loves. And it was still a mistake. By the end of this, you'll know the difference between a bargain and a trap. And Section 3 is the part most investors get completely backwards. In 2011, Buffett did something he'd avoided his entire career. He bought technology. Berkshire bought about 64 million shares of IBM. Roughly $10.7 billion. His average price, around $170 a share. And this wasn't a small bet. IBM became one of Berkshire's biggest holdings almost overnight. Buffett told shareholders he loved the buybacks. Fewer shares meant his slice would grow every year, as long as the business held up. That was the bet. That the business would hold up. But here's what nobody was watching closely enough. 22. That's how many quarters in a row IBM's revenue shrank. 5.5 years of the business getting smaller, quarter after quarter after quarter. Think about that. Buffett bought a company doing about $107 billion in revenue. By 2017, it had fallen to $79 billion. Nearly $30 billion of business just evaporated. The old IBM mainframes, hardware, services was being eaten alive. Cloud computing was exploding, and Amazon and Microsoft were winning it. IBM was the giant getting slow. So here's my question for you. When a stock looks cheap but the revenue keeps falling, is that a bargain or a warning? Drop your answer below, bargain or warning. Here's what nobody tells you about cheap stocks. A low price to earnings ratio isn't always a gift. Sometimes it's the market telling you the earnings are about to fall. This is the value trap. A business that looks statistically cheap, because it's slowly dying. And it's the exact opposite of what value investing is supposed to be. Buffett himself admitted it. In 2017, he went on CNBC and said something rare for him. He said he'd revalued IBM somewhat downward. Translation: I was wrong. By early 2018, Berkshire had sold nearly all of it. 6 years, $10 billion, and he essentially broke even. For the greatest compounder in history, breaking even is a loss. Because every one of those dollars could have been somewhere else. And it was about to be. While IBM was fading, Buffett found the tech company he actually understood. Apple. He started buying in 2016, the same window he was giving up on IBM. And here's the difference that mattered. IBM sold to corporate buyers who could switch vendors anytime. Apple sold to hundreds of millions of loyal customers who'd never leave the ecosystem. One had a moat. One didn't. That single insight was worth tens of billions. Apple became Berkshire's largest holding ever and generated enormous gains. Same investor. Same years. One trap, one treasure. The difference wasn't the price. It was the quality of the business underneath the price. Remember what I said at the start, the metrics IBM had were the metrics value investors love. Low PE, big dividend, huge buybacks. And it still failed. Because none of those numbers can save you if the business is shrinking. So here's the line I want you to carry with you. A falling business at a cheap price isn't a bargain, it's a slow motion loss with a discount sticker on it. Even Buffett got this wrong. That's the most freeing lesson of all. The goal was never to be perfect. It was to learn faster than the mistake could cost you. This is educational content, by the way, not financial advice. Always do your own research. So tell me, has a cheap stock ever trapped you? Yes or no in the comments. Tomorrow, I'm breaking down the one balance sheet number that spots a dying business a full year before its revenue drops, and you won't want to miss it.